Kenbright is a financial services company. We do insurance brokerage, we do healthcare administration, and we do actuarial and financial services. So two arms of Kenbright deal with customers on products and insurance services, and the consulting arm deals with advisory on actuarial, pension, and generally product development for the market. Uh, 2016, the growth was good, but some classes were a bit unprofitable, especially on the traditional classes like motor and medical. And the reason for that is because they're not specialized, so it's very easy for people to undercut. Right now, motor and medical, in general business, composed of 2/3 of the market. So there's very little scope for engineering or the traditional insurance business. So if the market is to grow, in my opinion, the other classes have to grow. And life, retail business did not grow as it should have, but it did. We saw limited improvement in the unit-linked side. Pension at least grew reasonably well in the market. Yeah. It's not really an issue of, it's not a very complex issue. It's a very simple issue, and the simple issue is that the cost of care is increasing. For example, we import 80% of our drugs, so any change in currency affects the cost of drugs. So if you see the dollar move from 85 shillings to 100, it means your cost of care will go up by that amount. In motor, your parts will be coming in with those expenses. So if you don't monitor your currency risk, then you don't see the expenses coming in. So whereas the motor is based on a percentage of the vehicle, people are not really pricing the risks that the market has. So there's that one component, and then the second component is that the work is not there. There's no analytics to say that this portfolio doesn't have as many accidents, or this age group is older, they'll be sicker. So then you have that problem where people don't really assess the book. They just renew on existing terms or reviewing the business differently. So those are the key challenges. And also because it's high frequency. High frequency means that the chances of an accident happening in a portfolio of 100 cars is very high. So the claim cost, if the cost of claims is increasing by itself, you'll find you're affected more on that. I know we all say fraud, but unless you can pinpoint it, it'll be a very subjective statement. I think the issue is pricing, but also of affordability. You see, let's forget about that. The reason prices are low is because people can't afford the benefits that they want. And the cost of care and the cost of repairing cars is increasing more than they can afford. Mm-hmm. So you find that the prices are a bit soft compared to what they should be. We always want to say that somebody is underpriced, but I think they have not considered the factors. Yeah. That's a better statement. Yeah. Let me give you an example. You can price your car, the cost of repairing your car estimated as 200,000, priced correctly, but if the dollar goes higher and imports come in at a higher price, the repair costs now go to 300. So did they underprice? So that's a bit subjective. I support that initiative because you have to control your costs. For every 100 shillings an insurer gets, they spend about 70 paying claims. So it's in their interest to control that cost. They can control their own employee cost and all those other things, but those only constitute 15 to 20% of the expenses. So if you don't control the 70, 60% of expenses, then you'll not be able to manage your business. So if I was an insurer, I would be importing drugs, I would be importing parts. Like drugs compose half of the cost of care in Kenya. So if you can predict it, you see, you're promising a client that you'll take money in January and you'll pay any claim between January and Christmas. Now, if the cost increases anytime between that, you take that cost. So if I was them, I would try and be a bit more predictable in my expenses. Yes. First of all, I think the products fit the customer. The only problem is we've not been able to explain the product. Yeah? Because if you look at life insurance, the only risk is death. There's no other risk that you can think of. Yet we have chamas who have funeral plans. Yet the insurers are not able to sell the last expense plans to the same people who already have their own structures. So people, when there's a death or a burial, they go to their families. Look at, for example, home insurance. People don't buy home insurance, but they've put all these protection measures. So they're essentially self-insuring. So the products are there because I don't see this, we are actually Kenya is one of the most innovative people. We came up with, I saw the blockchain approach with AIG. So, and that came from Kenya. I think it's just that we are not able to explain the products to the people. So people end up self-insuring and not really insuring with a third party, with the insurance company. Because whatever product you see, innovative products, you will find at the back is a traditional product. Whether it's microinsurance, whatever area you go, at the back it's a normal product. So if your house burns down, it's a normal fire policy. If somebody's sick, you get money, it's a hospital cash policy at the back. So you may find the products looking very innovative, but at the back the risks are the traditional risks. I think just a way we've not been able to make them flow with the customer's life. I think that's the innovation that's missing, and if that can happen, it will help penetration. Yeah. Bancassurance cannibalized brokerage. So instead of Bancassurance converting their own retail customers to insurance, they actually set up shop and just went for the corporates that were already in the sector. So penetration never increased because the whole idea was, if you look at where Bancassurance has succeeded in other markets, you actually have somebody who has the database of the customer. He knows this customer has 40,000 shillings every month sitting in the bank. Then they call you and tell you, instead of letting this money sit in the bank, let's do something about it. Let's take care of your risks and employment risks. What if you're unemployed? You can take some money out of it. If you're sick, can you take some money out of it? So they actually convert that client based on the information they have. That client, how much money they keep in the bank every year. So instead of doing that, setting up agencies and selling to their own customer base, the Bancassurance right now is actually competing with the brokerage, which is playing at the corporate sector. So I guess it's a race to the bottom, I guess. I consider myself an actuary before I consider myself a broker, but since we have Kenbright brokerage, my feeling is that obviously that has cannibalized the big ticket players. So obviously that has affected that. And also staffing, I've seen staffing move. But I guess also staffing has affected both brokerage insurance companies. But obviously I would say 30% of traditional brokerage business have migrated to Bancassurance, 30 to 40%. I think I should get a very big clap. I think the new rules are very strong on the audit risk management function, actuarial compliance, and the rules and the fit and proper tests and a few other items that really come on very strongly. And those are best practice, so they've really come on very strongly. So the chance of an insurance company failing now, it must really be a company which wants to fail. But a company that wants to succeed and ends up failing, those ones will be limited now. Because the people you hire, also the products you sell, sometimes the products you sell are the ones that make you fail, or the people you hire, or your balance sheet also, the risks you're taking. So the risk-based capital helps you in the risk, fit and proper test helps you in the people, and then processes help you on managing your day-to-day risks. So I think the regulators really come on very strongly there. Yeah. We do have such products on the motor and on the medical side. We do have such products. So we have the Kenbright motor and the Kenbright medical. But right now I want to restructure that to be more of an aggregator of products as opposed to selling one product. I think branding a product should be the work of the underwriter. I think a broker's work is to allow for comparison and relationships. So I'd rather a client know Kenbright as the comparison and the relationship person as opposed to having the product. You're not paying the claim. So I don't feel as a intermediary should brand a product if you're not paying the claim. The person paying the claim should be the one who should brand the product. I think we've seen it in other markets where if you're not paying the claim and the clients eventually know your product and they realize you're not the one paying the claim, they feel shortchanged. I think it's clear to be transparent from day one and tell them what our role is. Our role is product comparison, support on best price, relationships, and being their representative for insurance matters.